Good morning, we're Team 8. Abdullah, Dominic, Tung-Sheng, Vedang, and Quinn will present you with the management of political risk for BlackRock. For a brief introduction, BlackRock is a multinational investment company, and it is currently the world's largest asset manager, with $10 trillion under asset management. For better understanding, we split political risk into two categories by scope: the political domestic risk and geopolitical international risk. The former represents the risk of loss of return on investment due to political factors in the US. For example, political decisions, conditions, the change in government or legislative bodies that will result in BlackRock's financial loss. The latter, geopolitical risk, is the combination of risks that could cause geopolitical distress to the company across the globe. Here's a list of BlackRock's self-declared top 10 geopolitical risks. Among the 10, cyber attacks, terror attacks, and the ripple effect from political issues are the current biggest risk faced by BlackRock. It is interesting to note that cyber attacks are also considered a political risk, as it implies the disruption of physical and digital infrastructure, which will potentially cause major market movements. BlackRock faces a lot of challenges when managing this risk, especially when it is something that cannot be waited out. It is also a very common risk across the industry, as politics is everywhere and linked to everything around us. Regulations were also designed by lawmakers to help mitigate this risk by mandating the investment companies to implement robust risk management through identifying the risk of political interference and instability in foreign markets.
Political risks emerge as a result of public policy decided by elected officials. These include regulations, laws, taxation, economic guidance, and even culture wars. And because these policies can adversely affect BlackRock's bottom lines, they believe it's their fiduciary duty to push policies that are in their shareholders' and clients' long term best interests. Two prominent examples of public policies that have adversely affected BlackRock's income streams include the anti ESG initiative by Republicans and as well as the Basel III regulations. Because Basel III proposes higher capital requirements that could entail higher borrowing costs and as well as reduced returns. As a result, since the Fed has the final say in Basel III regulations, it is an important political risk. Meanwhile, we all know that CEO of BlackRock, Larry Fink, has been pushing an ESG initiative over the past few years. However, this has angered many people in politics and finance. For example, Democrats say that BlackRock is not doing enough, while Republicans say that BlackRock is overstepping its boundaries. In fact, this has angered some right wing officials, such as the Missouri state employees, and they have decided to pull funding from BlackRock to the tune of $500 million.
The US-China rivalry escalates the political risk for BlackRock, with ongoing economic tensions since 2018 exacerbating the market volatility. This instability particularly affects Taiwanese dollars, equities, and Chinese high-yield bonds, potentially leading to their depreciation in value and higher risk premiums amid the trade conflicts. For BlackRock, this situation could result in a downward adjustment of investment values in these assets. The Russian-NATO conflict, underscored by the situation, presents a significant political risk for BlackRock. The fluctuation could result in both upward and downward changes in energy sector values, impacting the BlackRock's investments, especially in the U.S. energy market.
Touching on how BlackRock has been affected through major events historically, we take a deeper look at their annual asset returns. As you can see, the red bars here signify the poorest performance and correspond to the percentage in each box. So moving in chronological order, we start off with 2015. We see that BlackRock primarily faced their largest losses in emerging market equities, Chinese equities, and commodities. This was a result of China's stock market crash, which sent ripple effects through multiple supply chains, as well as other economies who were dependent on China's productive capacity. In 2018, Brexit as well as Trump's election slowed down economies throughout the world. And when COVID hit in 2020 and 2021, we saw relatively positive performance due to high activity within financial markets. However, this was very quickly offset in 2022 with Russia's conflict with Ukraine, hikes of interest rates, instability of gas prices, the fall of the crypto industry, and fears of recession.
BlackRock manages its political risks in many ways. First is through legalized bribery. Although under federal law it's technically illegal for corporations to contribute their own funds to political campaigns, there is an intuitive workaround called political action committees, or PACs, which are basically organizations whose sole purpose is to raise and spend money to elect and defeat political candidates. BlackRock openly uses PACs on a bipartisan basis to federal level politicians to push its own desired public policies. For instance, with Basel III, BlackRock proposed minor changes such as allowing investment-grade companies without publicly traded securities to be eligible for 65% risk weighting. As evidenced by the chart on the right, BlackRock makes a lot of political contributions, with $1.85 million in 2023 alone. The second way BlackRock manages its political risk is through strategic political engagement and adaptability, or in other words, consistently nurturing a positive relationship with current and prospective clients. To do this, BlackRock engages with key policymakers such as the Fed for Basel III, and it periodically submits letters and consultations on how to approach a policy. Also, BlackRock always makes sure to maintain a political viewpoint that is always financially profitable. For instance, before 2021, it was profitable for BlackRock to push an ESG agenda. However, after the immense backlash, BlackRock decided to soften its views. And so, this is especially evident by CEO of BlackRock, Larry Fink, who made a recent comment saying that they actually expect to be long-term investors in carbon-intensive companies, which is a stark contrast from a company who was pushing ESG agendas just a few years ago. Yes, money talks.
BlackRock uses quantitative methods to quantify the geopolitical risks. One is BlackRock Geopolitical Risk Indicator, and the other one is market-driven scenarios. BGRI evaluates the geopolitical risk by analyzing the frequency and the sentiment of financial reports and news from Dow Jones, assigning the scores that reflect the market attention relative to the 5-year norm. Utilizing machine learning and neural network-based language models, BGRI assesses the relevance and sentiment of texts, creating the attention and sentiment scores. These are integrated using advanced analytics to form a composite risk score. A BGRI score of 0 indicates a historical average attention, while 1 signifies attention 1 standard deviation higher, indicating an increased market focus. Recent data has more influence in the scoring and highlighting the current market perception of risks. The market-driven scenarios framework by BlackRock evaluates the market reactions to geopolitical risks, predicting their short-term impacts on assets. A set of scenarios with econometric models for simulation based on the historical data and expert insights, as well as they will refine outcomes for unprecedented events. The resulting market movement index measures the alignment with projections and the asset return comparisons, rating them from -1, which means the opposite to what we expected, to 1, which means a perfect alignment with the predictions. This will help the BlackRock assess and convey the market responses to geopolitical events effectively. On the next slide, you can see here some examples of BGRI scores over time to assess the political risks respectively.
So the three main ways BlackRock can improve their management of political risk would be by expanding the geopolitical risk framework. The second would be through more transparent practices, and the third would be by getting deeper insight into the potential political risk. By diversifying investments across geographies and industries, they're able to spread their investments across various regions, and therefore they would be less impacted if a certain region, for example, the Middle East or China, as they were discussing before, would impact the political stability of a country. By scenario planning, they're also able to adjust their investments and therefore minimize their losses and develop proper contingency plans by creating simulations of different political scenarios. By actively engaging governments and companies, BlackRock has established strong partnerships and can communicate and advocate for more responsible governance through their investment portfolio. They're therefore able to enforce that companies can foster sustainable development and therefore mitigate the political risks that they would be exposed to, ultimately impact BlackRock's investments. Another growing concern for companies for the past few years has been ESG and how they're able to integrate that in their practices. By being more transparent about their strategies and risk management, they're able to address public concerns concerning the criticism, especially focusing on those sentiments that would be impacted by the confidence and political stability in the country.
In conclusion, we would say BlackRock's pretty mediocre at managing political risk, considering all the factors such as its risk models are backwards looking rather than forward looking, the nature of BlackRock's business, and also the fact that politics are becoming more divisive and BlackRock didn't account for it. It's probably true that BlackRock is not really managing this risk as well as should. Thank you for listening, and I hope you have a good day.